The Bank of Canada just lost control of the Canadian economy and they probably can't get it back. I'm serious. Bond yields are already flashing the warning signs. I will caveat that historically the bond market isn't exceptionally accurate at having consumers are actually having the worst time that they've had since the beginning of the pandemic. Our economy is growing, but it's growing primarily because of government spending. Canada Spends really tipped me off to this. I'm not sure if you follow them, but I would highly recommend that you do. It's a division of Build Canada. It's basically a non-partisan and not-for-profit organization that tracks everything that Canada is building and everything that Canada is spending. And they highlighted this from the StatCan release that I'm going to go through. It says increased capital investment was driven by government capital spending as business investment was flat. In other words, government spending is driving Canada's GDP growth. So while households cut spending, while businesses froze investment, while consumers started to pull back, the government stepped on the gas. Why does this happen? This is a hallmark thing that you'll always see during recessionary periods. It's happened in the 90s, it happened in the 80s, it happened in the 70s. It's called make work projects. When the government sees pain ahead, they start spending money to try and inflate the economy. Government spending is now driving Canada's GDP growth. And when the government spending becomes the engine of the economy, not households and not businesses, you enter something called fiscal dominance. This isn't a new concept to the Bank of Canada. In 2008, they published a staff working paper entitled The Welfare Implications of Fiscal Dominance. This means that monetary policy doesn't matter anymore. The Bank of Canada can cut, they can pause, they can scream into the void, and it will not move the needle on what's happening in the economy, because the real driver of GDP is Parliament Hill, not the Bank of Canada, not the debt and the capital costs that they can control. So in this video, I'm going to explain why fiscal dominance is happening in Canada right now, why today's GDP data actually says underneath the headline number that we're heading there, why bond markets are pricing higher rates, and why the Bank of Canada might not cut again for a pretty long time, unless maybe the government can outspend a recession. Let's dive into it. Okay, so today's GDP report basically blew the doors open. StatCan just told us that GDP rose 0.6% in Q3. Sounds pretty good, right? But when you peel it back, it gets a lot more interesting and a lot more concerning. Household spending is down 0.1%. Business investment is flat. Exports are barely up and mostly from energy. So where did the growth actually come from? Number one is a stronger trade balance as imports dropped and exports edged up. It's a good thing, but not organic domestic growth. Imports fell because Canadians are buying fewer goods. The number two, and this is the big one, is a massive increase in government capital spending. Government investment rose 2.9%, driven by a staggering 82% increase in weapon system spending, which we knew this was going to happen to have to hit. A lot of people on my YouTube have been talking about this in the comments. We knew this was going to happen to have to hit our targets that the US has been putting pressure on us for NATO spending, plus major institutional building projects like hospitals. All of this is part of this Build Canada initiative that the Carney government's been talking about. And for better or worse, this to me is, I mentioned this before, I mentioned this even during the election, that both parties were proposing deficits that were substantial enough that as if they forecasted a recession on the horizon. Now we're finally getting there, right? We just saw a record deficit in the budget. We saw, and the chances of them outspending that are probably pretty high based on the Liberal Party's track record. I try and set the politics of this aside. If I'm just looking at it from a nonpartisan point of view, spending a lot of money means that you're concerned that the economy is in rough shape. They're not going to say that out loud because they don't want one of the reasons why governments love to delay the recession announcement, as you might call it, is because that is when it starts to create panic and wear on consumer sentiment. So we were able to avoid the technical definition of a recession, which is 2 consecutive quarters of negative GDP growth, with this positive GDP print this quarter. However, I would say that it is worth noting that the report that Statistics Canada put out actually explicitly warns that these results are subject to larger revisions in the future because there's a bunch of data missing from the US government shutdown. And there's still a likelihood that it could come in negative, especially given that Q4 data is already trending down. So the key part here is that business investment didn't grow, government investment replaced it. That to me is the beginning of fiscal dominance. So let's explain what fiscal dominance is here. It's Fiscal dominance is a simple idea with enormous consequences. Normally, central banks control the economy using interest rates. They raise or cut to influence spending, credit, and inflation. But fiscal dominance happens when the government spends at such a large scale that monetary policy can't counteract. In other words, if they're spending so much and it's creating so much inflation, the Bank of Canada can't raise rates to push back significantly enough against that. And it's interesting, somebody mentioned this in my comments, like, do I think that the Bank of Canada governors are having such a tough stance on the government now because they know that it's being led by a former central banker who hopefully will understand that? It's a really interesting thought that I'll probably consider and address a little bit more in further videos. But even if the Bank of Canada wants to cool the economy, it can't because federal and provincial budgets are heating it faster than rate hikes can cool it. Think about it. We have billions in capital spending, growing public sector wages, even though we said that the public sector workforce would be cut. We have weapons system, huge military spending, infrastructure, hospitals, immigration-driven services demand, federal deficits, provincial deficits. There's so much going on here in Canada that is pushing the economy up, but it's not the economy, it's the government side. You end up in a world where fiscal policy drives GDP, not interest rates, not business growth, not investment. And that's exactly what today's GDP report shows. So why does this mean that the Bank of Canada is not in control anymore? We've basically seen since this release, the Government of Canada 5-year bond yield has been pushing up. You have most big 5 banks and most economists expecting rates to have to rise towards the end of next year as we start to see all of this spending move its way into the economy. The Bank of Canada has one job, right? Set the cost of money. They don't have a dual mandate like in the US, but the government controls the quantity of money flowing into the real economy through spending. So what happens when the government increases the spending at the same time the BOC is trying to cool the economy? The bond market typically will take control. Investors will look at the numbers and say, hang on, if the economy is being propped up by government spending, then inflation might not fall much further. And that means fewer rate cuts, maybe even hikes in the future, which is what most big 6 banks are predicting towards the end of next year and what the bond market is showing us towards the end of next year. This is why long-term bond yields are rising. And this matters to you in the real estate space because your 5-year mortgage rate is typically pegged to your 5-year Canada bond yield. Long-term yields reflect expectations about future government deficits, inflation, and future rate paths. And right now, the bond markets are saying, we don't believe the Bank of Canada, we don't believe a rate cut cycle is coming or continuing. And it's because, from my perspective, they see fiscal dominance.
Now it is worth noting that the bond market is pretty often wrong, as you can see on this chart here, so take it with a grain of salt.
So how does today's GDP print prove that? Let's connect each GDP component to this fiscal dominance. Household spending is down on a per capita and total basis. People are still tapped out. Vehicle purchases are down. Outbound travel is down. It's not a hot economy, right? Canadians are tapped out. We've maxed out our credit. We have no money left. We know this. We've known this for the last 2 years. Canadians are not feeling good. They're not feeling good economically. They're not feeling like they're in a good position financially. Business investment was also flat. Machinery and equipment was down 2.7%. Non-residential buildings were down 1.5%. Intellectual property down 0.6%. Businesses aren't responding to monetary policy. They're retreating, even though rates are coming down. Residential investment is up, but only because of resale activity. So if we look at house investment here, you can see new construction is actually down. So that's as far as I can zoom in. New construction actually fell 80 basis points. So we're not in that supply boom that I was talking about in previous GDP prints. The big red bar that's moving up there is your ownership transfer cost. So basically the real estate industry, realtors are doing more deals, which we know I've talked about this many times on the channel. We are slowly seeing an increase in the number of transactions. Government capital investment is up 2.9%. Weapon systems, as I mentioned, up 82%. Institutional buildings up. We have tons of hospital projects right now. I mentioned this like ages ago that we would see a huge wave of make-work projects designed to keep the construction industry moving when this pre-construction pipeline dried up. And now we're actually hitting it. I feel kind of vindicated, obviously, because my prediction was right, but I think that this was a pretty predictable outcome. This is the only real engine running in Canada's economy right now. This is why GDP per capita only rose 0.5%, despite our population actually falling. We're not actually growing. We are stabilizing our way through a recession through public spending. This is the story of a fiscally driven economy. So if households are slowing, if businesses are slowing, and the only growth engine left is the government, then the Bank of Canada has to keep rates higher for longer to counter the fiscal side, even though we're in a recession. because cutting rates in this environment would risk reinflating the economy through government demand, wage growth, public sector hiring, Canadians piling on debt again because we love to do that, infrastructure spending. And this is why markets are pricing out rate cuts. Bond yields on the long term are tending to rise, and the Bank of Canada is losing its grip a little bit. And the market's basically calling their bluff. The government has become the dominant macro force in Canada. So, what does this mean for Canadians? Number one, stop expecting rate cuts. They're not going to save you. For home buyers, bond yields drive fixed mortgage rates. If yields stay elevated, your mortgage rate stays elevated. For investors, cap rates have to adjust. They typically trade within a spread of your long-term bond yields. Look at Collier's cap rate report for a 10-year, the long-term chart on the 10-year bond yield versus national average cap rate. Asset prices need to reprice. This is not a low rate environment. We're not going back to ZERP. We might go down a little bit more if there's a black swan out there, which could be, China or the US, and we get a worse recession than what the government is able to push back against right now. For policymakers, fiscal discipline has basically been thrown out the window. And that's not just the Fed, like Ford's kind of in the same position. The Bank of Canada isn't helpless here, but they're no longer in the driver's seat. From my perspective, Canada has really entered an era of fiscal dominance, and the bond market knows it. And I think if you're one of the millions of people renewing a mortgage right now or in the next 365 days, you're going to want to pay attention to that. So I'll keep you posted as much as I can. If you want more analysis like this, the stuff behind the headlines, subscribe to the channel, check out my Substack link in the bio, and leave me your thoughts in the comments. Thanks a lot for taking the time to watch this video. I'll see you in the next one.